We have more guests joining us. Samiran Chakraborty, the Chief Economist and Head of Research at Standard Chartered Bank, and Sujan Hajra of Anand Rathi is also with us. Samiran, a bit of a nasty jar, you would say. Things were shaping up with the core sector showing 3.7%, exports growing for 3-4 months in a row. But 0.6 is a reality touch. No green shoots here?
Well, we were probably the lowest on the street with a 1.4% growth estimate for IIP, and the only reason why we had that number so low was that we were expecting this capital goods number to disappoint. If you recall, last month, the month-over-month growth in the capital goods index was 22%. So whenever we see such sharp jumps in capital goods, we have a tendency that in the next month that number corrects. I think what is going on here is that capital goods number has got corrected, and that's why we are showing a slightly lower print today. I would rather take these 2 months in together, the June and July, and say that roughly about 1.5% is where the industrial growth is, which is, well, neither here nor there, but not as disappointing as probably the 0.6 suggests.
Okay. Samiran, does that give you the feeling that you will stand by your 4.7% GDP growth? Anything at all in terms of changes to the GDP growth? After all, you've had a string of good export numbers. So we turn the corner in September, or you think 4.7 it is for the full year?
I think at this moment I'm comfortable with the 4.7. My sense is that the swing factor is going to be the agricultural GDP number, which will probably impact the Q3 GDP growth more than anything else. If we get a really robust agricultural growth print, then 4.7 can be pushed up to about 5%. On the other hand, if industrial growth does not pick up at all in the second half of the year, then probably we are heading towards a below 4.5% number. So these are the two upside and downside risks to that number.
Sujan Hajra of Anand Rathi Financial Services also joins in. Sujan, what is your first take on the numbers, and what do you expect a formidable pickup at least in infra/capital goods going forward? Sujan?
My focus actually was ahead of the consensus. I was thinking a 3% kind of a growth in IIP number for the month of August. So this is a disappointing number, and it actually doesn't add up because we had very significant export growth as well as we had the core sector numbers. So there is a bit of a disconnect here. But having said that, the capital goods is always the swing factor. And as you know, in the month of July, capital goods was unsustainably high in 15% plus kind of a growth number. So that was not likely this time. But I still think, given by the trends in export, the way it's going, and after all, the manufacturing sector is the biggest source of export. 75% of India's exports are of manufactured origin. So therefore, I think there will be a significant pickup in the export-related and import competing industries. So therefore, I think for the whole year, a 3.5% kind of an IIP number is still possible. And so therefore, I'm not, though I'm disappointed, I don't think this is unlikely that there will be a significant recovery in the second half. I still cling on a recovery in the second half.
Okay, I just want to revise the numbers for those of you who've joined late. The big disappointment that we are now reading out to you is the industrial output growth in the month of August came in at 0.6%. Basically 0.5% against widespread expectations of 2.5%. That was what Ekta's poll threw up. That would have been on top of 2.5% in July as well. That one has gotten revised to 2.8, but that any consolation from that gets wiped out by this fairly pathetic 0.5% performance. 0.6 overall comes in spite of a 7.2% rise in electricity, which probably is a lot to do with good hydel energy given the rains. But what has severely disappointed is manufacturing, which is really 80% of this IIP basket. That's come in at minus 0.1, which really means that year to year from August of 2012 to August of 2013, we have had no change at all. Industrial output remains the same, minus 0.1. Mining as well, minus 0.2. We have been used to this big 11% fall and big percentage point falls in mining. Now the base becomes so pathetic that we may not get very bad mining numbers. After all, those were the months when gas output started falling severely, as did iron ore output because of all the bans. Now we perhaps may start seeing a positive iron ore number. More on that from our guests in a minute, but one from a market expert, Ajay Marwa of HDFC Bank, joins us on the phone line. Ajay, big disappointment in the IIP number. How would you think the bond markets will care to react on Monday?
I mean, the bond markets are quite frankly, attempted to position themselves towards a flattish kind of inflation, and that's about it. I don't think the IIP number is going to be a big trigger. The concern really is the inflation trajectory. I think that's what the market's looking out for. And really the number on Monday is going to assume far more significance than the number today.
Okay, you don't see any positive reaction on the bond markets?
Well, I mean, we did see a small positive reaction this morning in anticipation of a poor number, and it petered out before the end of the day. And frankly speaking, the other way of looking at it is that, as you correctly pointed out, that most of the negative surprises, particularly when it comes to things like manufacturing, etc., are behind us. I mean, we are not going to see some massive negative surprise. We are at such abysmal numbers anyway that, you're not going to see massive negative numbers. You will see some small growth coming in, and perhaps going forward, particularly on things like power generation, etc., you should see numbers improve. So I think that is what the market will continue to position for and keep itself more concerned and more alert to inflation rather than to IIP.
Okay. Dipen Sheth of HDFC Securities also joins in. Dipen, your perspective, do you think that the markets would even react to this IIP data, considering that there has been so much volatility in the IIP data, and the fact that even the core sector data did not even translate into the IIP at all?
Yeah, I would largely agree with that view that this IIP data, although a disappointment on the headline expectation, of I think about 2% or so, is really going to be, just absorbed without even batting an eyelid. Right now, what's mattering for the markets is, the big picture comfort on whether money flows are going to come into the country or not. And that is a function of what is happening in the US on the debt ceiling argument. So I don't know whether these numbers matter too much, but yes, they do confirm our belief that there is no structural uptick in the capex cycle. There is no uptick in the manufacturing cycle, and the structural problems remain with India. But for a while, the markets might ignore this simply given the kind of momentum that they are riding.